So, hello and good afternoon. I welcome you to today's special webinar, special session here, exclusively for JFD Brokers. My name is Jens Klatt. I'm the Global Head of Research and Education at JFD Brokers, and we will have the pleasure to talk about the market opening of the US markets and, answer the question how to potentially trade the market opening. Nevertheless, what we definitely want to do on top of that is give an overview of what's happening currently in the market. So a very, very interesting day today. In fact, it's the day of the ECB rate decision. It so far hasn't brought anything new, but I think there's something interesting happening right now. And I think it depends a little on which assets you're looking at. But it could be that we are about to see a quite solid US session. So that's just a feeling. In fact, I want to present to you why I think that. Nevertheless, I don't think that the DAX can massively profit from it. And this has to do with the fact that currently the Euro USD is building a bottom here and trading back above 122. It's not that we are seeing huge volatility, and this is mainly due to the fact that before we start with this, let me just switch over here. And by the way, let me just do it that way. Open another one. So I've opened this one here from LiveSquawk because it's a great tool to get an overview of what Draghi said, and we will just go through the comments which Draghi made here in the next minutes. But I just want to make sure that one sec. So I just want to make sure that we are on the same page in terms of the ECB statement, which was published. So no surprise in terms of rates. Sure, ECB leaves rates unchanged. But here, if you compare the statements from today, or if you compare the statement from today to the one from the 8th of March here, you will find that there's no difference at all. So both statements are in fact the same. And in combination with the comments so far from Mario Draghi, which he made, not only here in terms of the statement, but also in regards to the questions from the journalists, the thing is that nothing was communicated, which results in an overall unspectacular rate decision in general. But, and this is the thing, nevertheless, there's a chance that we're probably about to see some bullish or some recovery, let's say, in the Euro USD here in the upcoming hours. And this has to do with the fact that over the last week, in fact, so since last week, Tuesday, Wednesday, Euro USD started to trade lower and accelerated on the downside here and traded as low as 122. So if you ask me, I'd say that was an anticipation of a dovish ECB, in fact. And so when the ECB now doesn't come out dovish at all, respectively, does not fulfill this expectation, and build, it built an expectation which was dovish, then even not saying anything at all and anything new at all will naturally result in a pullback here, in a recovery. And it's very likely, I think, that the euro will trade back above 122 and not significantly, but sustainable, stabilize above that level. Not sure whether we can really make it back above 122.50, but as you can see here, there was already a technical indication I meant in the morning meeting, in the morning here, when I said, well, we made lower lows, but these were not confirmed in the RSI 14 anymore, which seems to be a sign that probably we are about to see a bottom here. And currently, with the ECB, respectively Mario Draghi, communicating the way he does, well, then we have to say chances are rising that we are about to see a push back towards and respectively above 122 here in this context. So now the interesting thing is, when looking at the equity markets, for example, the DAX, then what you can clearly spot is that the DAX has seen some weakness over the last days here, especially accelerating on Tuesday after we attacked the region around the highs from last week, around 12,640 points. failed to break them, and then saw a quite significant pullback, which accelerated on Tuesday and even further yesterday, with a recovery happening then from yesterday onwards. But compared, especially on Tuesday, what happened, for example, in the Dow Jones here, in this candle, as you can see, the market dropped something like 600 points or so once again. So the thing is that compared to the US equity markets, the DAX presented itself quite stable. This could now mean that if the US equity markets, for example, see some bullishness today, and this is mainly due to the fact that I personally think that we are not seeing a significant break above the highs here from 2014, January, when we traded as high as 3.041% in 10-year yields. I don't see the market really pushing aggressively above that level, but I could imagine the market first to find resistance here, see some consolidation at an elevated level, and then seeing a break in the next days, 2 weeks probably, quite significant break, which could, by the way, then also result in a quite significant attack here at the 200 simple moving average, this blue line, which could mean that the market then, the Dow Jones, is really about to see a quite clear sign that this bullish mode since the election of Donald Trump in November 2016 will come to an end. So this is a very crucial level here, 23,200, 300 points. If we break below that, it's not only that we are breaking this 200 simple moving average, but it also means that we are about to build a sequence of falling highs and falling lows. And this is, I think, a quite bearish sign. If you wonder how far could such an impulse bring us, I'd probably go as low as 22,200, to be honest. But it's also depending on how good liquidity is, and that means if market really thins out for whatever reason, and we get to see some kind of flash crash, well, we could easily drop 3,000 and more points, as seen here at the beginning of February. But now let's come back to the current situation. I think that currently we have a good chance today in the US equity markets to probably stabilize a little, because I'm skeptical whether such a break here in US yields will really happen. And well, this said, it means obviously that I'm probably willing to trade the long side, even though I have to admit that, and this is something you definitely know if you followed this setup, this series, let's call it here, of those webinars around the market opening, that you can have an opinion, and this is probably giving your all-in-all automated trading strategy a discretionary touch, even though it could be that even if I prefer the long side, I could definitely end up with a short trade. And this is due to the fact that I had a predefined setup here, definition of the open range setup. And this is something I want to present to you now, where we define the open range between 1:30 p.m. and 2:15 p.m. GMT. So let me that's another approach. I've all the time just given away this setup set. Screenshot it and then work it out yourself. I'm not sure whether this is such a useful approach, but let's do this step by step now and define the open range. For example, yesterday, so we defined the open range between 1:30 till 2:15 p.m. GMT. So this is a 50-minute chart. So that means that we are looking at the highest high during this time period and the lowest low of this period. So the first candle here obviously has seen the highest high, which is 2,633.25. So this is the high, which is here. Oh, again here. 6. There we go. And let's do it that way. No, really? Okay, perfect. So now let's make it as bold as possible. And then we look for the low, which can be found here, which is exactly the low from yesterday. So this is the green line. And after we define this open range, what we will have to wait for is a breakout to happen on the up or on the downside. Nevertheless, we're not taking any signal, but we have to identify an advantage. And if we have identified the advantage, we'll trade the break in direction of the identified advantage. This is the second, respectively, the third step already. But how do we identify the advantage? Well, we do this based on the 15-minute exponential moving average 10 here. So that means, for example, we are looking, where is the S&P trading? Is it trading above the yellow line, or is it trading below the yellow line? If it's trading above, we are only taking long engagements. If it's trading below, we are only taking short engagements. So this said, it means nothing more than, obviously, we were triggered long here because the market traded through the highs of the first 45 minutes of trading, and we're breaking this open range here in pink. We're breaking on the upside, and we were trading above this yellow line. So this said, obviously, means we're going long here then in this case, and the stop is placed here below the low of this range. This is, by the way, what I just presented, not only the identification of the advantage, but already step 3, we trade the break of the open range in direction of the identified advantage. Stop, in this case, in our case here, below the low of the range, which can be found here. So, well, what do we do then? We wait till, in fact, 7:50 p.m. GMT. So this is the time then when we just take out the trade, meaning we just don't do anything at all. If the trade is stopped out, well, we are out of the trade. If it's not stopped out, we just keep the trade open till 10 minutes before the spot market closes, and that's it. And so yesterday, that meant we're taking out the trade somewhere here, I think. So 670, yeah, somewhere here, 637 or so. So in fact, it was nearly a break-even trade. So the breakout occurred, but there was never serious momentum on the upside, even though there wasn't also any momentum on the downside. So the trade was taken out here automatically. So we really don't care what happens within the trading day, but we just take out the trade at 7:50 p.m. GMT. That's at 10 minutes before the spot market opened here. So Wall Street, if you want, closes. So now you might say, okay, does this really work? Well, from time to time, obviously it doesn't. Respectively, this is by far the best outcome which one could imagine if it doesn't work out. Because on the other hand, you might say, well, we could have been stopped out here, right? So, but, and this is the thing, look at a day like Tuesday. That was like, it was just a great day for such an open range setup. 1 second, please. So we're taking this line here. We're doing the following. So we have to take this candle here. This is 1:30 p.m. GMT. We take the high, which is within the second candle. So there's the high. So obviously, you can also see the low already. This is here. We're trading below this line, the yellow line, the 15 exponential moving average 10. We're trading the break here with a stop placed above that level. And now see what happens. The market sells off, obviously, sharply. And this is the market environment you want to see when trading such a breakout, because here also the setup itself plays out its strength with having a clear and time-based exit of the trade. So you're not thinking about, well, probably I should take the profit here or something. No, you just keep the trade and take it out at 7:50 p.m. GMT. That's it. That's the rule, and you just live by the rule. So when we took out the trade, that was somewhere here, I think, 620 or so. And the reason I have some trouble to spot the real price is because it's 50, and we're looking at a 50-minute chart, which means the candle here is it's closing at 45, and then we have to wait another 5 minutes till the open of the candle. So it could easily be that the stop out of this position was significantly higher, but let's just assume somewhere here 620 to 625 or so. But the great thing about this is that the perfect example of how well it works, the setup, during times of strong intraday trends which develop here. And this is exactly what you want to see. Nevertheless, this is not happening all day, but it's happening from time to time. And you just have to keep on trading this setup and hoping that today will be the day once we get to see such a strong trending move here again. And let me put it that way. So now some would say, hey, don't you have an idea, or isn't there a feeling once we can get to see such a move? So to be honest, I was surprised by this move on Tuesday myself. So I didn't lose any money. On the other hand, I didn't win any money either. So my main asset, in fact, is not the S&P, even though I'm trading the S&P. Nevertheless, the main asset I'm trading and focusing on is the DAX. And the interesting thing about the DAX is the following, that I had a long position, which I planned to keep over the overnight, in fact. So it's usually a case that I am trading intraday positions, and I'm taking out the trade before the market closes here. So this is the latest point when I decide to exit the trade then. So do not have any risk overnight or something like that, gaps which could happen and all this. But taking the position intraday, you build it up, and then you take it out till or shortly before. This is the latest time. You'll just take out the trade then. And I held the position in expectation that there will be a further anticipation of dovish ECB here, which initially worked quite well at the beginning of the trading day, but then the market sold off here. So the trade was taken up break even, so everything's fine. But, and this is the thing, obviously, I had a complete different point of view when I came into the trading day and was completely caught by surprise by this sell-off here. The main reason potentially was what happened in yields. I didn't have it on the agenda. I'm not sure whether anyone out there had it on the agenda, since so far, I think that it was all the time the reason, by the way, why I think that this is the main initiator here for stocks in this case, then coming under pressure, not only on Tuesday, but probably keep on being under pressure in the upcoming days. Then also, it's a reallocation of portfolios, because you build big long positions here, potentially also sold aggressively volatility. This is an approach which is usually run by so-called risk parity funds. And then you, once yields start to rise, it becomes more interesting to invest in this case, treasuries again. So meaning that you start to reallocate and diversify your portfolio, meaning you take out you're closing out some long positions in equities, and then start to build positions in treasuries, for example. So to say that in a very, very rough way, just so one question, can you hear me? Am I still there? Hello, hello. Okay, it seems as if I'm now back. I was there was a short interruption. Could you just let me know whether everything's fine, and you can still hear me and see my chart? Okay, great. So yeah, whatever happened, I'm not sure, but I was just kicked out. Okay, so for whatever reason, but now obviously I'm back, and you can also see my screen. But the thing is. Okay, so this is interesting. Brian just said that Google has been doing this a lot lately. So that's probably not a problem at my end then. Okay, now the chart is also back here. Okay, well, I don't know what happened. Okay, whatever. So let me just come back to the point here regarding the reallocation. So this is what happens in this case. And this is what's building the pressure, and why this chart chart, which I already presented to you at the beginning here, is quite interesting, because the thing is, the moment we break above that level and yields keep on rising, it's not only that it becomes more attractive here, for example, to scale back in terms of equity long positions and rebuild treasury long positions because of higher yields being paid for holding such a position. But on top of that, it's also a big topic in terms of emerging markets. Remember that emerging markets really saw a significant boom, let's say, over the last years, thanks to the cheap money and liquidity which was provided by the Federal Reserve. So if this reverses now, there's a high chance that emerging markets, which, by the way, saw a sharp sell-off at the beginning of 2014. Some of you might remember that probably. That was the last time when we traded at this range. And I can really well remember, since it was a high volatile start to the trading year, even though I have to admit that over the next month, volatility dropped significantly, in especially the FX market. So it has been a very volatile, start into the year, but nevertheless, volatility dropped massively, and has also seen some let's call it restructuring in the brokerage industry. But the thing is that we're now trading back at these levels here, and with trade war fears right now building, there's also a chance that probably market participants start to become skeptical whether the Chinese will really see some or will keep on seeing significant economic growth here, which will naturally result in a high demand of goods being produced and delivered by emerging countries. So all this combined could easily spread and result in spread over the equity markets, resulting in some kind of risk-off mode here, and push equity significantly lower. That's, by the way, also what I meant here when I looked at the Dow Jones and the 200 simple moving average. When I said, well, if such a risk-off move spreads, such a push higher in yields could easily push us lower here below this 200 simple moving average, and also below 23,200 points, 250 points here on the downside, and resulting in a significant top forming then in the Dow Jones, which could easily drive us lower 1,000 points, and probably even more than that, down to 22,000 points. And this is definitely something worth remembering here, that we're currently seeing a quite difficult market environment. Nevertheless, that doesn't necessarily mean that we're intraday not willing to take long engagements, because I could imagine the market to recover here, or keep on recovering from those losses which were induced, especially here on Tuesday, and where we saw this sharp decline. So the market yesterday bottomed out, started to drift higher, and probably we'll see a market opening which will try to close this gap. So this is something I probably have to explain here. I have several lines here. For example, this one, the horizontal, the red line is showing the high from yesterday. So if we are opening above that line, that means that we are opening with a true gap, based on my personal definition here. So we are opening above the highs from yesterday. And so far, we can say it's only 6 points, which means chances are good that this gap will be closed, which means it could be a bearish impulse here on the downside, which is nevertheless not necessarily the real deal, but could be that this gap close happens and then we start to stabilize against the highs from yesterday, only to see the S&P then taking off from here. And so based on that, as you can already imagine or read between the lines, I'm kind of a guy who currently is positive, short-term, very short-term positive for equities. Sure, I'll trade the system, which means if it gives me a short signal, I trade the short side, since surprises happen, as seen on Tuesday. Nevertheless, currently, I think the market has a good chance to top out against those highs in yields here from 2014. Probably see some short pullback here or some stabilization, which could result in the S&P probably trade higher. And by the way, another driver, which is also coming into play here, probably something worth mentioning, we have to have a look here at the Euro USD, for example. So Euro USD currently is obviously finding a bottom, and as the DAX has seen some support, or European equities in general, based on the weakening of the euro over the last days. And in this case, then, not only that the US dollar becomes stronger, but also that yields started to rise. That was two things which weighed more heavy, obviously, on the US equities. Now, this could reverse if, especially, the US dollar probably will see some kind of pullback, some weakness here. This is something which could then drive the US equities higher, while European equities really can't catch up here, or can hold the pace, the momentum, which probably the US equity markets will see on an intraday time frame here. So yeah, based on that, I'm all in all quite positive for US equity markets. Not that positive on the European equity markets, but let's just see if probably there will be another push higher. Probably the DAX can see this catch up. Really, I don't know. We'll see within the next minutes, I'd say. So next 10 to 15 minutes here, in which direction the equities open. Even that does not necessarily mean that the market will keep on trading in this direction then over the next hours. But yeah, let's just see what happens. All we can see so far is that the DAX obviously sees or faces some trouble, as in fact expected. Based on the fact that the ECB obviously has not given the dovishness the market hoped to see, based on the price action over the last days. Then and probably now the DAX will lose some ground, or probably outperform on the downside if US equity sees some bearish action. That's also an option. Yeah. So any questions? Let me just see. This is great. Great explanation. So, oh, by the way, I'm not sure if I pronounce it right, but it's Prachwal, I think. It's probably it's Prachwal, who asks why does an open range happen, and Brian answers, think of all the balance of orders that want to get filled on the open, get done, that happen to tell you the general direction, respectively tone for the day. That's exactly right. So that's, by the way, also true for all markets. It's not only the S&P, but in case of the S&P, there's probably some differences also to the European equities, or respectively the DAX, for example, because when you look at the S&P, what you can see here is obviously some trading taking place within those two vertical lines. This is the closing price of yesterday, which is 8 p.m. GMT, so it's 10 p.m. German time. And then here now is the open at 1:30 p.m. GMT, so 3:30 p.m. GMT, German time. And now the interesting thing is that you can see candles within this, or within these two vertical lines here. So some might now say, well, probably this is some overnight indications, which is given from the liquidity providers or market makers or whatever. But in the case of the S&P, it's not the case. So in fact, there's trading taking place nearly around the clock. So there's a short interruption, a short break here, which you can see here. It's 30 minutes, in fact. So the candle at 10 moves another 50 minutes to 10:15, or respectively 8:15 in the case of GMT. And then there is an interruption of 15 minutes. And trading resumes as at 8:30 then. So within those 50 minutes, there's no trading taking place. But then trading keeps on happening, at least, let's say here, till 11 p.m. GMT, no, German time. So it's at 9 p.m. GMT. And then it resumes again at 10 p.m. GMT. And so as you can see, there are small interruptions during or between 10 and between 8 and 10 p.m. GMT. But all in all, there is trading taking place nearly 24/5, not 24/7, but 24/5. And the interesting thing now is, by the way, now you can see here this tendency that we are open with this small gap, and now the S&P is trading lower. By the way, let me just have a look here at the DAX, how the DAX reacts to that. Probably the DAX sees some, no, that's not significant enough, let's say. But as already said, it could be that the European equities / the DAX in this case will see more and harder selling pressure if selling pressure hits the US equities here. But let's come back to the open range. So the interesting thing with the DAX is that there's no trading taking place between 8 p.m. GMT and 6 a.m. GMT. So there's in fact a gap, as you can see here. So market closes at 8 p.m. GMT. So this is in fact the last candle, and then trading resumes on 6 a.m. GMT the next day. So this is something which is in fact quite interesting, because to me it gives or it makes a difference in terms of how I define the open range, because, and this is especially true here. By the way, let me just write this down. Probably that makes more sense. So trading hours in the DAX. So German. So the FDAX, which is the future DAX, trades between 6 a.m. till 8 p.m. GMT. So these are the trading hours for the FDAX. But there's also the so-called Xetra trading. So in fact, the FDAX is the future DAX, as the mini S&P, right, for example. But the Xetra here, it's a purely mathematical construct, which is derived from the 30 biggest shares in the German economy here. It's the so-called blue chips like Allianz, Daimler, whatever, Adidas, for example, Continental, and all this. And you can trade the Xetra DAX. You can only trade the FDAX, but you can calculate the Xetra DAX based on the weight within the DAX here. And Xetra DAX trading is taking place from, in fact, 9, which is 7 a.m. GMT, till 3:30 p.m. GMT. So to give you the equivalence to this, let me put this here. Oh, so this is the E-mini SPX future traded at the Globex CME, and the other one here, not sure, is it pendant? Sure, that's just how we call it. Okay, and this one is the, let's call it also pendant, the equivalent here to the, let's call it Wall Street SPX. So, and this is now really interesting, because usually you do not see such or in fact, if you compare the market opening in the DAX to the US market opening, what you'll usually see is that the DAX usually it really escalates, let's say. So sometimes it's just really, it's crazy what you get to see around the market opening. That has not only to do with the fact that the DAX itself is quite light compared in terms of volume and the overall broadness of the market it covers, and market depth in this case. But it's also that due to this fact here, that there is such a huge gap between the closing price in the evening and then the opening price in the morning, that you usually see some quite erratic moves. And this is something which in my case results in saying, you know what, I'll wait another 5 minutes till all this let's call it rebalancing, as Brian exactly wrote here, has taken place, and I'm not stopped into a trade, which is or seems to be a pure coincidence here in this case. So yeah, just to give you an idea of how this could affect, in fact, defining such an open range. And by the way, the DAX is seeing further pressure. So obviously, this is mainly resulting now from the fact that the S&P probably sees a gap close. This is exactly what's happening here. And now the question is, we will find support here against these highs. Still, by the way, this is a completely different approach, by the way. This has no impact here on our overall setup, which is clearly to wait 45 minutes and make sure that we have a clear defined high, respectively low, and then wait for the breakout to happen in one or the other direction. Wow, this is really cool. So I pronounce Prajval the right way. This is something which makes me proud. Yes, I think this is. By the way, this is very good. It's. I mean, it's only a rule of thumb, but it's a very good rule of thumb. It's like, as a broker, we used to always say, never trust the first hour of trading. And by the way, the interesting thing about this is that there are many approaches out there. There are very many approaches out there which aim on exactly that. First hour of trading. Okay, you have to adapt this a little, sure. Nevertheless, that's also true for example, currency markets. So there are trading approaches out there which are looking for trading the breakout of the Asia range. So usually what you get to see during Asian trading hours is that there's not much volatility taking place. I'm not sure whether that makes sense. 1 second. Probably we'll go over here. I just hope that we do not have so many lines within here. What do you see here? Yeah, so this is when trading starts in Japan. In this case, you have a, in this case, low here. It's 2 a.m. German time. By the way, where do we have it? Here. So, so you can then do the following. You'll say, I look at the high and the low during Asian market hours. By the way, that was not what I wanted to have. 1 second. Here. So, and then you say, let me just see. Yes, that's nearly perfect. You look at those 6 hours of trading. So meaning you look at the high and the low between 2 a.m. German time. This is 0 a.m. GMT, yes. And then 6 a.m. GMT. And usually during Asian trading hours, you usually do not see many action to happen. That's also true to some or for some Japanese for some Japanese currencies is wrong, for a Japanese yen here, for some cross pairs, but especially true for currencies which do not cover Japanese yen, for example, here. So in this case, we're looking at GBP USD, for example, and GBP USD does not see big volatility during this time. So it's, in this case, it's 39.28, the low, and the high is 39.49. So it's nearly 20 pips. It's a 20 pips range. And then what you say is, I'm trading the breakout of this range on the up or on the downside. Also here, you can adapt and work with a filter, like an exponential moving average, for example, and trade the break then in direction of the identified advantage, for example. And in this case, you can see that if you duplicate this range, it happens quite often, in fact, that the market, after breaking out of this range, at least moves once this difference here in direction of the breakout. So in this case, obviously it's a perfect example because it worked out in the morning here. Within the last trading hours, obviously, GBP has reversed those losses and in fact now trades in the green for the day against the US dollar. But all in all, this is an approach which can be profitable here and which aims on the exact same logic, let's say, as does, for example, the open range breakout in the S&P or also in the DAX. And in fact, what I can say is, for example, there's an approach in the Euro-Japanese yen, which is working with an exponential moving average, and I'd like to show it to you. Probably that makes the most sense. So today, for example, didn't work out. So sometimes it doesn't, but it does the following. It looks at the first hour of trading. No, I'm sorry, not the first hour of trading. We are looking at the time span between 1 a.m. GMT till, 1 second, it's 8. Yes, 8 a.m. GMT. And then we trade the break as described before. But, and this is an interesting thing, here we have, for example, a filter. So this is the range, obviously. So this is the high of this candle. By the way, this is the level where the stop is placed. So it was a quite close call for those who traded the breakout of this range here on the downside. And then we look at the low of this range, which is here. And this is, by the way, it's 132.96. This is where the trade was obviously triggered here at 11 a.m. GMT. And by the way, now on top of that, we also add something to this, which is, well, by the way, where is it? Here. We add an exponential moving average to this. It's the aggregation is 11, so it's very, very short. But as you can see here, we're trading below this, and then we're trading the break out of this range on the downside. So here is where we trade below the exponential moving average 11. And this on the hourly chart, and there is the break happening. And then we trade in direction of this advantage. So the same is true, for example, for, let me give you an example, which is, by the way, I know why this is probably happening here. Not sure, but okay. What I try to see is, okay, no, okay, then it's only the problem is that it's a little choppy. But for example, here, so there was the break which happened. Let me just see. Do we got stopped out? Unfortunately, we got stopped out. I just want to give you an example where it worked. Where it worked, in fact, quite well. Was it last week? No, I think it was last week. There was a trade which played out really well. So we're trading a managed account, and we have this approach here on this open range setup on the Euro-Japanese yen going. And I was just wondering, when did we saw this trade? To just give you an idea of, was it last week? Yeah, no, yes. Wednesday, Thursday? I'm not sure. Probably it was here that it took place. However, doesn't matter. In fact, it doesn't matter. So just let me write down the let me just write down the parameters for the Euro-Japanese yen trade setup here. Breakout setup. So we look at the time span between 1 a.m. Range definition between 1 a.m. And 8 a.m. GMT. Then you trade trend filter. It's the EMA 11 on an hourly chart. Obviously, when you're trading above, you're trading in direction of the advantage, which means you're trading not only the long side. If you're trading below, you're only trading the short side. And now the interesting thing is, while the stop set above below the high low of the defined range, The target in this case is different from the one I just presented on the S&P, for example. We call this the risk here in this case. We call this 1R, which means the target is 1.7R. So that means the following. If you say the range in this case, example, let me do it that way. Example, range. That means if we have the low of the range here at 32.96 and the high of the range is here, that's 33.25. That means we're talking about 29 pips, obviously. Okay, so it's the difference. You say you're entering the trade here, placing the stop above. That means obviously it's 29 pips. So 29 pips. We do it that way, 29 pips, and this means 1R is 29 pips. Let's put it that way. So now you want to define your chance, respectively the target. Target, respectively chance, is 1.7 multiplied with 29, which equals to 1.7, 49.3 pips. So this means that you can now say, okay, from 132.96, you go down 49.3 pips on the downside, which is bringing you to, oh, by the way, I just made a mistake. 1 second. It's 139.6 minus this. So it's 132. So target in our case, it's 139.468. Oh, by the way, no, it's 47. Right? It's 47. Yeah, sure. Let's do it that way. This is where our target can be found. So that means that we're now going to this level here, 47. And now you can calculate it yourself. You will find out that this is 1R and this is 1.7R. And this is the setup, in fact. So let's just see how this develops. All in all, some might now say, oh, this is great, right? The euro Japanese yen is just dropping. Doesn't this necessarily mean that the DAX will probably rise now? Not necessarily, because the Japanese yen could also see some strength here based on some unwinding of carry trades or some risk aversion, which is ridiculous because risk aversion looks completely different here. But that could also mean that even if the euro is dropping right now, the DAX is dropping too here. Let me just see. Yeah, and this is in fact the case. So it's a different story, let's say, when looking at Euro USD and Euro Japanese yen here in this context. So obviously the DAX can't find any bigger support. Again, probably we are only seeing a gap close here. Nevertheless, the thing is that we just have to wait another 25 minutes from now until this candle has closed and then the next one has closed. So we have a high and we have a low. The interesting thing is, by the way, if we now get to see the market finding support here, and which could then mean that with a trade out of the open range, there could be a kind of a combination between a momentum trade here, which is something based on the gap close, which we could define as a momentum trade, and on top of that, a breakout trade then in direction of the open range, in this case on the upside. So yeah, that's it in fact. So today, obviously, we're not only focusing here on the S&P, but also on the Euro Japanese yen. I hope that currency traders are happy about this. So yeah, do you have any further questions? Any around other asset classes, expectation, research on certain markets, whatever. So let me just double check here. Okay, so that looks good. Okay. Very interesting. Question on gold. So I read between the lines, I read some skepticism around gold. I have to say, I'm very, very positive for gold. And please let me explain why. So when looking at gold currently, some might say, well, where do we have it? Here. Some might say, well, look at here the market in this case. By the way, I'm looking at the daily chart, so it's a longer time frame than probably most traders watching this right now look at. But I think it's definitely worth to step back here. Because the overall outlook for gold is, I think, very positive. That means also for midterm engagements. So when we attack this level here around 365, the thing is that we failed to make a new high here in this case, and currently seeing some pressure, mainly, I think, induced by US treasuries taking a hit, respectively, yields are currently pushing higher. So this push higher in yields here means that that the let's call it yieldless investment gold becomes more unattractive, and that's why it's seeing some pressure forming here, and obviously having trouble to see another attack at this level. Now, the thing is that I still think that gold is performing extraordinarily well compared to this currently rising yield and market environment. And so I think that rather sooner than later, I think gold could see some serious demand. And this is not necessarily attached to, or it doesn't necessarily need to yields to see dropping here, but it could also be that there will be the break higher in yields, which could nevertheless result in some quite aggressive deleveraging risk on being the market could see some risk off mode. Nevertheless, gold as a classic safe haven could then see some serious bids here and see a quite significant attack at this level. And now, by the way, let me just it's not only a feeling. I think that gold is performing quite well here, but I want to share something with you. But therefore, I hope that I just get some further data here. So let me just see. Hopefully it works. How far can we go back? This is great. So it's only 2012, but that's fine, because now what we currently do is we look at the daily chart here. Oh, by the way, that doesn't make sense. Let me just do it another way. I have a better idea. So then I don't need to remove all those lines here. Gold. What do we have? No. Okay, weekly chart. Obviously, this is not so good. Let me do it that way. And then let me see. Yeah, okay. So now the interesting thing is the following. What we can see here currently forming is a ascending triangle. Usually I'm not, let's call it a chart pattern guy. So this is usually none of my business. So usually I'm not looking at this, but in case of triangles, descending and ascending ones, I think the theory behind this is quite interesting. And let me just explain why. Well, what we can obviously see is that the market has seen some serious resistance here in this case, it's slightly higher, but all in all, has seen some quite significant resistance in the region around 360 to 370 here. And now the interesting thing is that, and this is a weekly chart, so you can see that we are here going back to 2014, in fact. So there has been some supply coming into the market and pushed gold lower in 2016 after a very solid start into the year, in fact, quite significantly. Then we've seen another attempt to break this level. There was, again, supply coming in, but as you can see, the supply was diminished quite soon. Another attack. Now the market doesn't even see not even close as much a supply as it did in 2016, nor as it did in 2017, but stabilizing at this elevated level. What does it tell us is that obviously the supply is having trouble to overcome the demand here. And this is a clear sign that a bullish break is potentially around the corner. And I think if we break above that level, gold has a minimum chance, a minimum target on the upside, which can be, by the way, then drawn here by looking from the high of this formation down to this point. It's a very rough way, nevertheless, just to give you an idea, if we break out here, you can see that this could result in the midterm then, in this case. So we're not talking about a one-day move, that would be probably a little too much, but I think we could easily make it up to 1,700 USD per ounce if we break above that level. So yes, gold has seen some, has definitely seen difficulties here, breaking out of this ascending triangle, but nevertheless, the overall fundamental outlook definitely speaks in favor of gold long engagements, especially midterm engagements. And with the break above 360, 370 on the upside, I definitely see some further significant rise in the upcoming months to probably upcoming year, then which could easily push us up to 1,700 USD. This is also, by the way, let's come back to the fundamental side here, something which shouldn't be forgotten. I mean, we see a quite huge and huge drop is the wrong word. We see a quite aggressive flattening of the US yield curve, which means that short-term yields rise quite sharply, mainly due to the fact that the Fed is rising rates and finding itself in a rate hike cycle here, while long-term yields are not rising as sharp as short-terms do. This is something which is surprising because currently you're looking at this chart here and saying, okay, what are you talking about? I mean, we are rising to the highest levels since 2014 currently, and we are about to break this level. And this is quite huge push then. Yes, but the thing is that short-term rates, in this case 2-year yields, have risen up to 2.5%. So which is nearly as high as on 10-year yields. And the last time we've seen such an aggressive flattening of the US yield curve was shortly before the US recession, the last one hit, that was in 2008. And that said, it means that with the overall economy or the economic outlook worsening, I think chances increase that we are about to enter a recession in the short term, which is then historically a positive sign for gold in this case, which would, by the way, underline my argument to be bullish gold here with a target of 1,700 USD per ounce, probably even higher than that. Yes. And that's it from my end. I just have a look at the watch here. It's 2 p.m. GMT. We still have another 50 minutes to wait till the range is defined, which is, by the way, a very, very positive thing. Oh, by the way, you can see it here. Now demand is coming into the market. And nevertheless, we are not trading long. We're not trading short. We still have to wait. This is, by the way, something I think Jesse Livermore, in his book Reminiscences of a Stock Operator, called it sitting tight, but it was in regards to an existing position where he tried to let a winning trade run here. Nevertheless, patience is key in this context. And the great thing is, if you have a clear preset rule here or definition and setup, which you have to wait for to develop, well, it becomes quite easy, because you definitely know when to take action, how to take action, and then if the trade happens, yeah, only to take action in this case, and just trade the setup then in this context here. And therefore, again, we have to wait another 15 minutes. And yeah, let's just see whether the setup plays out or not next week in the morning meeting. The morning meeting is tomorrow, 9:30 a.m. GMT on the YouTube channel from JFD Brokers. But next week here on FX Street, we'll have a look at this again, if this setup played out. And that's it from my end so far. I wish you all the best. Happy trading. Take care. Watch your stops. And if you have any questions, please feel free to shoot me an email. I'd really appreciate it. Really happy to answer your questions. And yeah, all the best. So talk to you again next week. See you and bye-bye.